Could this be the financial lifeline millions of Americans need? Former President Donald Trump has proposed a bold new policy, capping credit card interest rates at just 10%. To make things even more interesting, he's found an unexpected ally, Senator Bernie Sanders. Imagine the relief for countless families drowning in high-interest debt. But as with any major financial change, it's not without controversy. Let's start with the basics. Credit card debt is one of the most expensive forms of borrowing. Right now, the average interest rate hovers around 20%, with some rates climbing as high as 30%. This means that for every dollar you owe, the cost of simply carrying that balance can snowball quickly. For many Americans, this creates a vicious cycle. Minimum payments barely make a dent in the balance, while interest piles up month after month. A cap at 10%. That's like giving borrowers a parachute to escape free-falling debt. But here's the catch. While the benefits of such a policy seem obvious, the reality is much more complex. Let's talk about how this would actually work. Credit card issuers, like banks and financial institutions, use high interest rates to offset risk. People with lower credit scores are considered higher-risk borrowers. By charging them more, lenders ensure they're compensated for the potential of missed payments or defaults. A 10% cap could disrupt this entire model. Critics argue that such a cap might make it harder for people to get approved for credit cards in the first place. Think about it. If lenders can no longer charge higher rates to higher risk individuals, they might simply deny those applicants altogether. The very people who rely on credit cards to cover emergencies or everyday expenses could suddenly find themselves shut out of the system. And then there's the impact on the economy as a whole. Credit cards are a major revenue stream for banks, not just because of interest rates, but also because of fees, late charges, and interchange fees paid by merchants. If interest rates are capped, lenders might look for other ways to make up the difference. Could we see an increase in annual fees, or even new charges for things like payment processing? It's hard to say, but history shows that when financial institutions lose revenue in one area, they often find ways to recoup it elsewhere. Now, let's zoom out and consider the broader implications. For everyday consumers, this cap could bring immediate relief. Let's do some quick math. Say you have $10,000 in credit card debt at 20% interest rate. If you're making only minimum payments, you could easily end up paying thousands of dollars in interest over time. At 10%, however, you'd cut that cost in half. That kind of savings could help families pay off debt faster, save for emergencies, or simply breathe a little easier. But not everyone is convinced this is the right solution. Some financial experts argue that the real problem isn't interest rates, it's how credit is used. High-interest debt is often a symptom of bigger financial challenges like stagnant wages, lack of financial education, and limited access to affordable loans. A 10% cap might help in the short term, but it doesn't address the underlying causes of debt. And let's not forget the potential for unintended consequences. Some experts worry that if credit card companies tighten their lending standards, people might turn to riskier forms of borrowing, like payday loans, which often come with interest rates of 300% or more. Others warn that a one-size-fits-all policy could harm smaller credit unions and community banks that rely on interest revenue to stay afloat. So, where do we go from here? The proposal is still in its early stages, and it's unclear whether it will gain enough traction to become law. But one thing is certain. This debate has sparked an important conversation about the role of credit in our lives. For decades, Americans have relied on credit cards not just as a convenience, but as a lifeline. Whether it's covering medical bills, unexpected car repairs, or simply making ends meet, credit cards are deeply woven into the fabric of our economy. As we wrap up, let's consider what this means for you. If a 10% cap were implemented tomorrow, would it change how you use your credit card? Would you be more likely to pay off balances faster? Or would you feel more comfortable carrying debt, knowing the interest is capped? And what about those who can't qualify for credit cards under stricter lending standards? How do we ensure they still have access to safe and affordable borrowing options? The truth is, there's no easy answer. But one thing is clear: our relationship with credit needs to evolve. Whether this proposal becomes a reality or not, it's a reminder that financial policies can have a profound impact on our everyday lives. It's also a call to action for all of us to take control of our finances, understand the true cost of borrowing, and advocate for systems that work for everyone. So, what's your take? Would a 10% credit card interest cap help or hurt consumers? Let us know in the comments below. And if you found this breakdown helpful, make sure to like this video, subscribe to the channel, and share it with someone who could use this information. Together, we can navigate the ever-changing world of personal finance and come out stronger on the other side. Thanks for watching, and we'll see you next time.